All right, today we're going to talk about some of the original investment commentary and podcasts and the top articles for Validea's Grew Investor blog for the week of April 23rd. So to start, Jack, I'll let you talk about your second piece on value traps and sort of some of the ways that while value traps can't completely be avoided, some of the things that we do here to try our best to stay out of trouble with some of these value trap type companies.
Yeah, just to define value traps, the idea is whenever you're buying a basket of cheap companies, you're betting on the fact that over time the market has overestimated how bad things are with them. But there'll be a group of companies where the situation is actually worse. You're betting on average, but inside of that, there's going to be a bunch of companies where the situation is worse than the market thinks it is. And that's basically what a value trap is. And so that's sort of the holy grail for value investors to figure out, how can I eliminate, how can I just have the good companies in there and how can I eliminate these value traps from my portfolio? So I really had 2 points with the article. One is basically that it's not possible to eliminate those. No matter what you do, if you try to completely eliminate value traps, you're probably going to derail your entire value strategy because you're also going to eliminate companies that end up doing well. So the first part was to say, this is a very difficult thing. And if you're trying to eliminate value traps, you're probably just going to add a little bit of value around the edges at the most. You're not going to make some massive increase in your returns. But then the other thing was I wanted to talk about some of the things we've used in our strategy that might help to eliminate value traps. And so for us, what we try to do everything from a practical standpoint. So we try to say, if I'm sitting here as a person and I wasn't running a quantitative strategy, what would I look for in a value company that would say, all right, these historical results you're relying on, these results are not reliable. Something has changed and something is dramatically worse with the business than what you think. And so what I did is I outlined some of the criteria. I won't go into all of them, but I outlined some of the criteria in the article that we use to do that. And so an example would be, for instance, if analyst estimates for a company for the current year are way, way, way lower than the previous year, then something in that previous year has obviously changed. And so our valuation ratios are relying on that previous year, but the future year is much lower. And so what we do with our system is we use a bunch of criteria like that. We rank all stocks, and then the bottom 10% of our database, so the absolute worst stocks, get removed. And so the idea with the article was just to talk about some of those things we have found might help to eliminate value traps, or at least to limit them, in our research.
Yeah, it's like this concept of using a negative screen to kind of just get out the ones that are absolute worst, that score the worst according to, sort of this quality composite. And I do think we'll probably end up podcasting about that at some point. So when we do, we'll be able to kind of round it out a little bit more with some back and forth between us.
Yeah, no, we definitely need to do a podcast at some point to dig into that in a little bit more detail. What was our podcast this week?
Yeah, so we did, we kind of followed on to your article on bubbles, and we talked about the 3 keys to understanding investing bubbles. And we sort of asked ourselves, in the podcast, or what we discussed is, first, if you're going to think or try to determine if you're in a bubble, you first have to know, well, what is a bubble and how do you define it? And then, number 2 is, even if you think you can define it, can these things really be identified in advance? And then number 3 is, well, even if you are in a bubble, what are you going to do about it? And that was kind of the thing that we, on the one hand, it's very tough. Most investors probably shouldn't be doing anything about it because it's, you could be wrong, and you could be wrong for a long time, and you could, maybe leave a lot of money on the table. But there might be some small, or let's say medium, things that you can do, like get maybe a little bit more diversified or do different things to maybe remove some of the risk if you think we are in a bubble. Certainly the market's very expensive here based on most traditional measures, but there's been times in the past where it's been very expensive too. And, it's continued to go up, and this is a very unique time with the economy reopening and, growth coming back, firing on all cylinders by most measures. So yeah. So anyways, that was the podcast. I think it was a good discussion. We got some good feedback on it. And
yeah. So should I go ahead and sell all my Dogecoin, or do we think?
Yes.
Yeah, probably. And I actually don't own any Dogecoin, so I wish I did, given that it was up 200% or something last week. But
and then you can go buy some NBA Top Shots NFTs. Go for it.
Yeah, exactly. So, but I think what you said is true. The most important question is the last question, which is basically, what can I do about it? Because as much as we all like to talk about, here are the criteria for a bubble, or here's maybe how I can identify it, these things run way longer than anybody thinks they can. And so you can't short them. The best you can probably do with a bubble is maybe try to avoid, the really overpriced assets, or you could maybe start tilting your portfolio towards some things that are not, towards value or something like that. But anything you're going to do to try to combat a bubble is going to have side effects, because you're going to look different. And when you look different, you're going to underperform, and the bubble's probably going to go on longer than you think. And, you may want to jump back in, if you do it too early. So there's so many problems with bubbles that for your average investor, other than avoiding the things that are not, your standard stock market that are obvious bubbles, there's probably not too much your average investor can do.
What article jumped out at you this week on the blog?
It was an article about Goldman, and they're talking about how humans beat algorithms in ESG. And I thought it was really interesting because ESG is one of those things that is really in the eye of the beholder. Every single person has a different definition of ESG. So I think they're probably right about this. It's very hard to build an algorithm or to build like a fund or something like that appeals to everybody's definition of ESG. What you can do is maybe you could develop a quantitative strategy that allows each person maybe to customize their ESG portfolio to what they think personally. But, this is really a situation where a human can really help out a lot, because there's so many different things about ESG you can consider and so many different ways to look at it. And a lot of times people look at the same exact company, and one person will say, this should be included in an ESG portfolio, and one person would say, it shouldn't. So for instance, if an oil company is something that you would say, obviously, that probably should not be in an ESG portfolio, but then a lot of these oil companies are starting to invest a lot in renewable fuels or something like that. So at what point have they invested enough in renewable fuels that they should be included, and it offsets what they're doing on the oil side? So I thought that was very interesting, and I think that's probably a place where humans will have a big role going forward, because ESG is really in the eye of every single individual person. What was your article?
So the article that really jumped out at me was an article around founder-led companies and how basically they outperform the rest. And what I didn't realize is this article is actually very old. Sometimes on the blog, we actually uncover articles that, aren't necessarily written recently. And so this was an article in Harvard Business Review that's actually written back in 2016. But I think, a lot of what they uncovered here with founder-led companies actually probably even applies more today. Continues to apply today. So the first thing that these researchers found out was, that these founder-led companies actually outperform most other companies. So if you were to create a index of founder-led businesses, a lot of these companies actually have great performance in the public markets. And so then the question is, why is that? Well, they kind of came up with three things that really got at what is in a founder's mentality: insurgency, frontline obsession, and an owner's mindset. So basically, insurgency is the idea to challenge industry norms, something like a Netflix or Google that kind of comes in and creates an entirely new market, sort of off the ground. Because without this sort of insurgency mindset, they say companies can become directionless and uninspiring. A lot of these founders have a frontline obsession. So that means they have, very important and good attention to detail. And then, the last thing, obviously, and this probably goes without saying, but they sort of take an owner's mindset. So they really look at it like they own the company, they're custodians for sort of the business and their shareholders. And they don't want to get bogged down in the bureaucracy of, large companies and stuff like that. So it's interesting. I don't know if I think there's a couple ETFs out there that focus on founder-led businesses, but off the top of my head, I can't name one. So I'm surprised if maybe I'm missing something. I don't know. Do you know? Is there any ETFs that?
I don't know either. I'm not aware of it. I'm sure there's got to be, but I'm not. I know the data is very widely available.
Well, there's you have Amazon, you have Berkshire Hathaway, you have Tesla. What else you got? Well, you have Netflix. A lot of these kind of come out of these new, younger, what I would consider relatively younger technology companies that still have sort of the founder at the helm.
Yeah, this is really interesting to me because you're seeing a lot of this qualitative data sort of go into the quantitative space. And so when I think about this, I always think about it with my quantitative hat on, is this a factor? I can get the data now for founder-led companies. Is this a factor that should be incorporated into some sort of, growth strategy or in some sort of process? And there's a lot of data like that these days that's out there, where maybe a lot of this data that would have been considered qualitative stuff that wouldn't be considered in a quant strategy, some of that stuff may over time come into quant strategies. Now, the downside to that and the challenge with it is you're not going to have the long-term track record with this kind of stuff that you would expect from the type of data you typically would use in a quant strategy. So that makes it more of a challenge. I mean, you can't go back probably 50 years and get data for, how founder-led companies have done relative to other companies. So that brings a challenge into it. But I do think you're seeing a lot more firms use this kind of stuff in their processes and not just value and momentum and things like that. You're starting to see some of this other stuff come into the picture as well.
Yeah, that's good. That's a good point. So, okay, guys, thanks for checking out this quick little episode, and we hope to see you next week, and we'll see you next time. Thanks.
Thank you.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.